Welcome back to Trader Sage. It's been a long time. I've been hopefully getting better. As a trader, as an individual. I've been doing a lot of shadow work, right? So it's like necessary to like understand myself better, so I can understand what's holding me back and what are my strengths, what are my weaknesses. And I determined that a lot of the things that I've been disseminated on this channel has been unnecessarily complicated. All right. So my my motto, my motto is to do less better. To do less better. All right. So we have this 3 ATR channels, 20 EMA on this 4-hour high time frame chart. 3 ATRs in general, it's signifies that price is overextended. A natural move in general would be 2 to 2 ATR. All right, if it's consolidating 1 to 1, what I mean, like 1 ATR to 1 ATR. This is not about ATR channels. Just 1 to 2. Right, so this is kind of normal. This is a positive 1, negative 1. This is the 20 EMA. Right, so this is normal, a normal distribution. Right, but anyway, that's not the point. We focusing on the 3 ATR overextended, prices too high, needs to, like it did here, 3 ATR, mean revert back to the moving average, right? So pull back to the moving average, came back up, ran these highs, previous week's highs, pull back again. We have a lot of different tools here to support price going higher again. Went from a premium into discount, pushed back up higher, ran the high, held above the high. And a 3 ATR channel, we have this small upward consolidation, this climax bar. You have an inside bar here, which kind of supports price going lower. But those are all side notes. The real star of the show, besides this 3 ATR channel, is this violated bullish fair value gap, or a buy side imbalance, sell side inefficiency. And in general, these bars open, low, high, close for the bull bar, and we're gonna open high, low, close for the bear bar. So we have a bullish fair value gap overlapping with what would have been a bearish fair value gap. What I mean by that is, if that candle didn't run back up, this would have been open. So we have price rebalancing with this wick here into this balanced price range, because we have buy side offer, we have sell side offer, then we have this wick stabbing back up. So the fact that this has been violated lets us know that the change in the state of delivery from bullish to bearish has been solidified, has been hard coded, right? And you see this bullish fair value gap also being violated here. You're not going to highlight that, but you can. And one of the things, the dominant, we're going to use this one, discount the premium. So we have the equilibrium is here, and we can see price traded back and up above equilibrium before it continue lower, targeting this low primarily, and then we can get into that later. All right, so we can draw this out, eyeballing it, of course. And so that's equilibrium. take that off. I'm just gonna swing low. That's the target. Another swing low as a target. And also why I didn't highlight this inverted fair value gap, which is valid. Still needed something to go above 50% of the range if we were expecting some type of retracement. And we have price trading back above. So we have a false breakout above the 20 EMA as well, if you wanted to do that. But we treat wicks. There's a bearish fair value gap here as well. But also prior to that, we have this long wick. And I'm bringing that up because we treat wicks like gaps. So we divide them into quarters as well. Right. So for our high time frame chart, our time frame that we're looking for market maker buy and sell models on is the 15-minute. So I personally go from the 4-hour to the 15, or the 4-hour to the 5. As Sensei mentioned, as ICT mentioned, if you study the 4-hour and the 60-minute, something along those lines, you treat it like your daily chart. And then you went to a 5-minute and looked at structure. I'm paraphrasing. A whole new world will open up to you. This is one of the benefits of what I'm speaking of. All right, so far everything has been done on the high time frame chart. This is legitimate. If you prefer to trade in the 4-hour, these are legit entries. These are legitimate entries here. Here, stop would have been up here or here. This is these are all reasons to continue lower, to support price lower. If you don't trust it here, then obviously you can just get out, or you can go to the lower time frame to manage it, like in this case the 15-minute. All right, so we have this being violated here. And on this time frame, you have this run up. We already spoke about that. And then we have this drop down, this displacement, violating this bullish fair value gap, and trading into this bearish fair value gap. I think that's a little off though, right? Let's see. All right. And that's straight. And we're gonna make that paint the town red, right? Because we're bleeding out. So this is the same except for earlier entry, and that needs to stay. Take that off of there, right? So we can, you don't have to label any of this, right? Because we can see these levels only on this chart. These are additional. So 15-minute, we're not going to drop lower than this. All right, so this is an entry, short, and actually with 2 offers, right? Or multiple here, 1, 2, 3, 4, 5, 6, a return to origin, right? Still your stop. So despite this drop, there's no market structure shift, right? We do have this bullish fair value gap here. I always go for, sorry, this just formed. I still always look for stuff back here, and particularly fair value gaps or inverted fair value gaps. I'm not going to talk about breakers and order blocks and propulsion blocks and stuff like that. Those are mitigation blocks. Those are important, but they're not necessary. That's not part of your repertoire. I'll tell you what is part of my repertoire is optimal trade entry, longs and shorts. It also goes well with my model. All right, so we have optimal trade entry. I don't know if you can see that. Let's go 10. We have optimal trade entry. All right, if you want to make sure you get in the trade 61.8, the stop is still up here. We can only use the bodies if you like. That's fine. So I'm eyeballing this right here, the lowest body and the highest body here. So we still have the optimal trade entry, and then price ran below here. Yeah, kind of like ran below this low, ran below this low. And when price breaks a significant level or key level, you should expect some type of retracement or retest of that level. So all of that's in here. And we have this I hate when it like drawing over here and it mucks up the other side, you know. Let's make this times like 3 or something, 4 maybe, just so it can be clear that that's what that is over there. So we have optimal trade entry short, return to origin 61.8, and we have price dropping below here. And that brings us to this level here. That's all of that. And this time frame we have. All right, so let's do this. Restrict that to only this time frame. And let's, because that's something I used to do as well, is I used to take this 4-hour fair value gap or inverted fair value gap and then find the equivalent of it on the lower time frame. That's what that's kind of how it became clearer to me. So we have another inverted bullish fair value gap here. So this is a 15-minute. Guess I should just start writing it, but 15 more minutes. 15 more minutes. All right, that's 15. All right, so we have 1 entry, 2 entries, drop. Here's your 3rd entry, right? So we have, and this is intraday is after hours or the Asia session short. And I'm only showing all of this so I can get into tonight's trade, which is this short here. And I'm just showing that this is a bearish order flow, and we only taking trades in the direction of the high time frame chart. And we have this here. Right, so we have this consolidation. We have this bearish fair value gap here. You can see price traded down to 4 standard deviations. It's really probably 5. Do we have a 5th one here? Like 5.5. What am I talking about? All right, so didn't quite reach 6 standard deviations from this to this, right? So, but it's 5 standard deviation. This was an excellent run, right? But this is saying again, like I said it before, but this is the 4-hour chart. So typically trades on the 4-hour chart. If you were to take trades on the 4-hour chart, in general, these trades last between 1 to 2 days. 1 to 2 days. In this case, it's 1 day, 2 days, and going into the third day. And this is the ESO. So we have here change in the state of delivery here with this displacement. Optimal trend entry short. I'm gonna turn this back down to 8 because this like man. All right, a little bit better, right? This just got tired of all these words and all this noise on the chart, so that's all that is. All right, so we have that, and obviously we targeted this low, 4-hour low, and this low, and we treat wicks like gaps, so we could divide this into quarters as well and pull that over. This time frame we have the 8:30 highlighted, the weekly open, and we have the Asia highs and low, weekly highs and low. That's about it. And we can visually see the previous day's high, previous day's low. So that's something as well. So price ran below the previous day's low. If you want to count this as the Asia low, ran below that, and then retest. Then remember we said that when price breaks a significant swing high, swing low, that it does some type of bounce, right? So in this case, it retraced into this bearish fair value gap. So we're gonna leave this on the 4-hour chart, and we can all right, so we're getting closer to today, right? So this is the continuation, right? So we have a mean revert break, mean revert to the pretty much the EMA, still showing that the trend is bearish, and we have a sell model here, and sell model completed. A retracement after breaking the key level, retrace into a bearish fair value gap again. Hopefully this is clear. I'm trying to be as clear as possible. That is the goal. Let me know, right? Trying to have some level of precision. All right, so this was a reason on this time frame to consider going lower. See, it didn't trade above the midpoint. The bodies held below the last quarter, the last quadrant of the wick. So this is even more reason to consider going lower. The bounce was relevant because it traded back up into premium just to go back down into discount and take out the low. So we have all of this inside of this range, from this high to this low, this internal range liquidity, regardless of, we can get granular and say these was the swing low here, this was external range, this was a range, this low to this high, broke that, obviously significant low, it bounced, rebalanced that, drop, left this open. So all right, so we are here where we are today. All right, so here we have a run on stops followed by market structure shift. This all right, so we have a run above these swing highs into a bearish fair value gap. It's also optimal trend entry short as well, and this is just how I see things. You don't need to see things like I see it. All right, let's take this out for now so we won't get confused. And let's restrict that to this time frame and lower so it doesn't show up here. All right, so we have optimal trade entry. Let's do this one. Okay. So this is consolidation. Obviously, ran the low, ran the high. Off the trade entry still 78.6. So we got a run on stops. We have a violation of a bullish fair value gap here. So we have all these reasons to accept price going lower in alignment with the high time frame chart. Still needs to be adjusted. All right. All right. So where were we? All right. So we have this bullish fair value gap here. Violate it. And we have a bearish fair value gap. We spoke about that over here. Where we have a bullish fair value gap overlapping with a bearish fair value gap. And this is a balanced price range now because price offered buy side and offered sell side. And this is a trading model in and of itself. This right here. It wasn't the topic of discussion, but this is what we call the institutional order flow entry drill, where you can consider entering at the very low here, very low of the imbalance. So this high here would be 74.59.25. The entry will be 74.59.75 or 25 still. So it's two tick difference. That's an excellent entry at 2:45 p.m. All right, so we have the smart money reversal, balanced price range, which also signifies a change in the state of delivery, provided you are going in the direction of the higher time frame order flow. And everything else is straightforward, right? Kind of highlighted that, continue lower, taking out this low, getting closer to, again, well, I mentioned 1-to-1, but actually a normal distribution is 2-to-2, right? Like in terms of normal price movement, 2-to-2 would be sufficient, but we'll see, right? Nothing's guaranteed. Maybe let's read, right? So we had a gap down, shows a sense of urgency for price to go lower. And we are, this candle what closes at 2 a.m. EST. That we reach 2 standard deviations. Well, target 2. Didn't reach 2 standard deviations. That's down there. But that's for this setup. All right. All right. So that highlights all of that and gets us to tonight. Price opened up here, weekly open, big bull bar into this bearish fair value gap. That's sufficient. That is good enough. That is good enough to all right, that's VWAP, right? Prices, VWAP is pointing down, going down. I'm gonna throw the 20 and the 50 EMA on there. That's also, right, just so you can see, 20 and the 50, because I don't have the short one on, which is the 9. Right? That already shows us that, hey, smart money reversal, drop. Here's your low risk sell. If you didn't take the one up here, low risk sell is the 5-minute chart. We've been describing the 15-minute chart this whole time. 4-hour 15-minute. We just flipped it, right? Because it's everything is together, right? So now, because it's the Asia session, I use the 15, the 5. I think I mentioned that, and try to avoid the 1, but you can cook there too, but it's not necessary. All right, so we let this happen. If you didn't see this as a continuation short here, we we let that happen. And you want to wait for like the Asia kill zone, 9 o'clock. But still, all right, so let's fine tune this to the 5-minute. Right, so we have that run on stops, and you don't exactly see any shift, right? So probably would have missed all of these if you didn't take this short here. But we do have, this looks like a balanced price range. This area in here. This bearish fair value gap, bullish fair value gap. So order flow is bearish here. Bearish order flow, retracement, continuation. Let's see. No, almost. Measured move. Didn't have to do it that way, but I did. That's 66 points. Mirroring this here. There's no guarantees though, but that puts us pretty much right in alignment with the previous week's low. So continuation short. Price failed to go higher. And you see price traded into here, which you would say, hey, should send price higher. But order flow is bearish. So it bounced, violated, and here would be your, you could either use this bullish fair value gap or the bearish one here. Maybe let's drag that. Let's do that. Reclaim bearish fair value gap, overlapping A. All right, so that's your entry below 50% at the low here. Traded below this week's opening, previous week's opening. So you can call it new week opening gaps if you want, but I don't draw the gaps. I just use the weekly opening price or the level. I don't even know what the price is, but you can determine that easily. I think that, I don't know. I think that's it, right? So we have that. So we have this high, this low, often trade entry short, and almost 4 standard deviations in price. So what do we say? 4 types of trade. So continuation, trend continuation. So the pullbacks is still part of, still part of the continuation, right? So with trend, another pullback here. This broke this level, retest into this bearish fair value gap. So high time frame draw on liquidity, this low, on the 4-hour chart. So took that out, retest, and say a level, a swing low with a gap makes this level even stronger. So you can draw that out if you wanted to. That's just the level. So support and resistance. You can see the bodies held below this level. And you can see that the bodies of the candles held below 50% of this range of this fair value gap. And Then you get to targeting this low on this time frame, this low, or that low on the 15-minute. And that's it. So it's no guarantee that price would go here. You could retest this and keep going, or retest it and go down. But right now we're in the value zone between the 20 and the 50 EMA. And we are still technically still bearish, but I wouldn't wait for price to go back to a 50 EMA. It already violated the 9. That would be a reason to hold as a momentum run. But I think that's all I got. Please like, comment, subscribe. All this noise on the 4-hour, you gotta come up off that. So I'll highlight that. And all right. Oh, that's not the 4-hour, that's the 15. Apologies. It's better, I think. But yeah, all right, same principle over there, like we mentioned on the 4-hour, applies over here. Price right in the 20 EMA, violated, retrace back into here, short, retrace, short, 3 ATRs, and a bounce. So we see, right, mean reversion to the EMA is possible, or this bearish fair value gap, and then continue to take out this previous week's low. That would be, so we want to see what happens when price trades into here. Right up in there, which is pretty much the weekly open. So let's see. I'm out of here though. Thanks for listening. This is my A+ setup. The whole situation is an A+ model. Thanks for listening. Please like, comment, subscribe. Let me know what you'd like to see. And until next time, peace.